Hey, welcome. So today we are going to pull back the curtain on the huge, and I mean huge, fast-paced world of Forex trading. If you've ever wondered how literally trillions of dollars zip around the globe every single day, you are in the right place.
All right, to kick things off, let me ask you a question. Just take a second and think about it. What do you think is the single biggest, most massive financial market on the entire planet? Is it stocks? Maybe something like the global bond market?
Well, if you guess stocks or bonds, you'd be wrong. The answer, and it's not even a close race, is the foreign exchange market. We just call it Forex. The scale of this thing is honestly hard to wrap your head around. It makes all the other major markets look tiny in comparison.
Okay, so let's zoom out for a second and get that 30,000-foot view. What exactly is this global monster that we call the Forex market? Let's break it down.
You know, at its heart, the idea behind Forex trading is actually pretty simple. It's just the process of turning one currency into another. You're basically buying one currency, and at the exact same time, you're selling a different one. And the whole point? You're hoping to make a profit from the tiny shifts in their values against each other.
So, what really makes this market tick? Well, like we said, it's the biggest by a long shot. It also runs 24 hours a day, 5 days a week. It literally follows the sun around the world. And unlike a single company stock, currency prices get moved by huge things, like major economic news and political events. And whether you make a profit or a loss, well, that all comes down to whether you can predict which way those prices are going to move.
All right, so that's the big picture. But to actually get in the game, you've got to learn to speak the language, So let's zoom in and get our hands dirty with the ground-level mechanics and the terms you absolutely have to understand.
Okay, first things first. In Forex, you never, ever trade a currency by itself. It's always in a matchup against another one, and we call that a currency pair. Think of it like a constant financial tug-of-war. So when you see a price for something like EUR/USD, that number is telling you exactly how many US dollars it costs to buy just 1 euro. And if we look even closer at that pair, you've got two parts. The first currency, in this case the euro, is what we call the base currency. It's always the one. The second currency, the US dollar, is the quote currency. That's the part that goes up and down. So when you buy EURUSD, you're really just betting that the euro is going to get stronger compared to the dollar.
So how do we even measure these tiny little price movements? We use something called a pip. A pip is basically the smallest standard change in price. For most pairs, it's a change in that fourth number after the decimal point. That super tiny little jump is how traders count their wins and losses.
Let's make this real. Let's walk through a simple buy trade. So imagine you've done your homework and you think the euro is about to get stronger against the dollar. Based on that gut feeling, you place a buy order on the EUR/USD pair. And then it's simple. If you're right and the price goes up, you make a profit. If you're wrong and it goes down, you take a loss. That's really the core of it.
So that kind of covers the how, but what about the why? I mean, why are millions of people, not to mention giant companies and banks, jumping into this market every single day? Let's check out the main reasons.
For most individual traders like us, the biggest motivation is speculation. It's all about trying to profit from those short-term price swings. But it's not just about that. Huge international companies use Forex for something called hedging. It's how they protect their profits from unpredictable currency changes. And then, of course, there's the incredible access. It's a market that's always open somewhere, which means there's a constant flow of potential opportunities.
Okay, now listen up. We've talked about all the exciting stuff, the opportunity, and the profit. But we have to talk about the other side of that coin, and that's risk. I'm telling you, this next section is probably the most important part of this whole explainer, especially for beginners. This is the pro's playbook for how to survive.
So let me be crystal clear about this. Before you even dream about the profits you could make, you have to be obsessed with managing your potential losses. Every single winning trading strategy, no exceptions, is built on a solid foundation of risk management. It's not about being right 100% of the time. It's about making sure that when you're wrong, the damage is small. And your number one weapon, your first line of defense, is something called a stop-loss order. A stop-loss is just an automatic command you set up that closes your trade for you if the price hits a certain point. It's your safety net. Trading without one is like trying to juggle chainsaws. Just don't do it. Seriously, it's non-negotiable.
The next rule, it's all about picking your fights wisely. You should only be looking for trades where the potential reward is at least as big as your potential risk, but preferably bigger. If your potential reward is 2 or 3 times your risk, it means you can be wrong more often than you're right and still come out profitable. Think about that.
And that leads us to maybe the single most important piece of math in all of trading, your position size. This is all about deciding how much money to put on any single trade. When you get this right, it guarantees that even if your stop loss gets hit, you'll only lose a small, manageable percentage of your account. This is how you stay in the game long term.
Now you're going to hear the word leverage thrown around a lot. It's a tool that lets you control a big pile of money with only a small amount of your own. And yeah, it can make your profits look amazing, but you have to remember it is a massive double-edged sword. It blows up your losses just as fast as your profits, and a tiny market move against you can totally wipe you out if you're not extremely careful.
And finally, after all the charts, all the rules, and all the math, there's you. A trader's two biggest enemies are greed and fear. They're emotional hijackers that make you throw your perfectly good plan right out the window. Trading is a mental game, just as much as it is an analytical one, and learning to control your own emotions is a skill that takes time to build.
So there you have it. You've got the rules of the road now. But here's the real question, the one that matters most. Do you have the discipline to actually follow them? Day after day, especially when things get tough? Because that right there, that's what separates the pros from everyone else. Thank you for watching. If you got something from this, please like the video and support the channel by clicking on the subscribe button. That really helps us. Thanks again.